Welcome to the Liquidity Event, a show about all things personal finance with a laser focus on taxes, financial independence, and equity compensation. Hosted by AJ and Shane of Brooklyn FI, each episode will focus on a personal finance topic, some driven by news headlines and sometimes driven by listener questions. And sometimes you'll just get two money nerds rambling about what they think is interesting. Just a quick note before we get started, this podcast is for informational purposes only and should not be considered tax or investment advice.
Hello and welcome to the Liquidity Event. We are your host, Shane Mason.
And I'm AJ Ayers.
And this is episode number 136 being recorded on February 18th, 2025. It'll be airing on February 21st. Quick reminder for you listeners, we will answer your questions live on the pod. If you leave us a message, you can disguise your voice and use a fake name if you're a silly Billy Shy, silly goose. And the link is memo.fm/liquidityevent.com. I see somebody re-added the crazy language in here that I deleted. What's going on, AJ?
I'm doing well. I'm doing great. How are you?
Stuck the landing on this weird pronouncing. I'm good. You are in Palm Springs, I can see from your background. How is it in Palm Springs?
Well, now it's beautiful. It's about 70 degrees, sunny outside. So as soon as this podcast is over, I'm going to go sit by the pool and read a book.
You're not going golfing today? I thought you were the...
No, I golfed yesterday and the day before, so I'm taking a day off. My hands are all calloused and fucked up.
Oh, yeah. I better soak those in the pool.
Overgolfed myself.
You overgolfed yourself. That is possible, right? Like you can play too many holes.
Yeah, I think I've done it. I think I'm done in. I needed to stock up though for 2 months of no golf, basically.
Stocking
You're
up
pouring, or Shane is, for those watching or listening and not watching, Shane is pouring himself from a beautiful chrome French press into his Johnson's Space Base mug that he got, I believe, from his Christmas gift from his sister of meeting an astronaut for breakfast. Is that correct?
Thank you so much for that segue into something about my personal life that I want to shout out my little sister for giving me, who's 5 years old, for giving me the best Christmas gift I've ever received, except for the Nintendo 64 I got in 1996. I don't know when that happened, but it was totally changed my life. Second best gift ever. My little sister got me a meet an astronaut at the Houston Space Center. My sister lives in Houston. So I go to this thing at 8 a.m. I get there at 8:03 and they're like, "Where have you been, sir? We've been looking all over for you." It started 3 minutes ago. I go in, it's me and an astronaut.
Maybe I should become an astronaut.
Me and an astronaut and about 14 9-year-olds. So it was super fun. The questions were hilarious and awesome. Anyway, so we have a really interesting podcast episode today, AJ. We are going to do a deep dive into incentive stock options today, which are, of all the options, the most applicable for a deep dive. Would you agree?
I would agree. I just want to say, I'm so sick of your bullshit, though.
I'm so happy that we get to hang out together on our podcast together.
I'm so glad you said that.
I'm incentivized to have a great episode with you today, AJ.
Alternatively, I'd like to discuss a minimal commitment to in-person work in the future.
Wow. Wow. Well, based on how fuzzy your episode is, or your camera is right now, we're going to have a fuzzy... Oh no, I'm throwing her off. AJ, dear listener, the listener, AJ is experimenting with a new setup. I'm not sure what she's trying to do. I think she's playing with her new iPad, which are back, by the way. AJ, iPads are back?
iPads are back. Yeah. iPads early on were like boomers, like you can't use them. A lot of tech doesn't work on them. Like, what are you doing with an iPad? Now, 5-6 years later, they're back. Now, if you're an executive and you don't have an iPad, like, what are you doing? Like, you're an idiot. If you're in the Delta Lounge and you're not working on an iPad, you're an idiot.
Are iPads back, or are you just closing in on 40 years old?
I don't know, but I loved it. I watched a movie out on my patio. Then I did some blogging. Then I worked out with my trainer virtual. Like, I am just living the iPad life.
I use an iPad.
That was the bougiest sentence I've ever said.
No. This podcast is half journal entries between you and I, just to keep ourselves up to date. Who cares what the listeners think? But also, occasionally some knowledge.
Yeah, you guys, we run a remote company. Like Shane and I need to have forced hangout sessions, or Brooklyn and I will completely implode. So.
Absolutely.
So you just get to witness us having coffee. When we started the podcast, Shane, remember we were drinking because we would record it at like 4:00 on Wednesdays.
Yep.
But we both decided that was bad for our health, and also our marketing team couldn't turn it around quickly to edit it if we did it at nighttime. So,
right. Thus the lost double entendre of the liquidity event being us having a liquidity event together and an IPO. Yes.
But for today's episode, the title is quite apt, wouldn't you say?
I'm so excited to deep dive into this topic today because we're going to...
I'm so glad you said that.
This joke's got legs, baby. I was going to do some sort of comment about how fuzzy your camera is and how fuzzy everyone is on how to handle their incentive stock options because they are such a complicated item to handle. So today, first of all, I want to plug all of Brooklynify's content, mostly written by your co-host, AJ Ayers, here on the PCast today. We have a lot of great articles about how to exercise your options and an ISO guide, as well as tons of YouTube videos on how to handle your incentive stock options that will all be linked in today's show notes. But in an effort just to shoot the shit, so to speak, I'm so excited to discuss how you and I think about incentive stock options, not just as advisors, but also as recipients of incentive stock options. Miss Ayers here has received ISOs in the past. Do you want to give the listener a bit of context so we can get an idea of like what you've handled in the past, AJ?
Absolutely. Yeah, I would say Brooklyn FI's origin story is deeply tied to ISOs because back in the day, I was working at a tech company when I was a little baby music journalist, and didn't know my Roth IRA from my mega backdoor Roth IRA. And so I got an option grant, didn't know what the hell was going on, ignored it, filed it in the drawer. But then as I became more interested in personal finance, I remembered that I had equity compensation. And when Shane and I first met, I said, "Hey, Shane, you're an accountant. What am I looking at here? What is this? What are these incentive stock options?" And when we started Brooklyn FI, this was like 2017. Then a year later, Brooklyn FI gets started. We sign 1 million clients in the first 2 months. Instead of staying at that tech job, which I loved, I had to quit. Thus starting my 90-day window to exercise my incentive stock options. So I decided to exercise my options. It was a small price to pay at the time in terms of the cash outlay. We'll get into this, but my exercise price and the fair market value of my incentive stock options at that time was equal. So I did not have to pay any AMT. So that was a great move on my part. And, you know, I was very lucky because this doesn't happen very often, but the company that I had exercised those options for actually had a liquidity event. We actually, we didn't go public, but we were acquired, and I had a nice little exit. An exit, I don't mean to say that like my exit was the size of a minivan, basically. Let's say that was the size of my nice little exit.
I thought it cost more than my boat.
It was like a little nice little minivan, like a nice souped up, like the newest Chrysler, like right off the assembly line.
Pretty sure it was Tesla level. Pretty sure
was it brand
new. I thought it was. I thought there was a 7 at the front.
There might have been a 7 at the front.
Yeah. Revisionist history, dear listener.
Minivans are expensive. Doesn't a minivan cost like a nice minivan, like 60 grand?
How much could a banana cost? $20?
How much could a banana cost? $10?
Lucille Bluth is my co-host today on the podcast, dear listener. Glad to have her back.
There are minivans that cost $65,000.
Yeah, I mean, self-driving minivans. Hell yeah. Okay. All right.
Anyway, I am a success story of exercising your incentive stock options, being at the right place at the right time, and a successful liquidity event happening. So, you know, when I talk about incentive stock options with our clients, like I have real world experience going through it. It means something different. And most of our clients did not have an experience like mine where it was not the amount of cash that I had to lay out to exercise my options was not a material percentage of my net worth at that time. Whereas a lot of our clients and a lot of you listeners, perhaps who are thinking about exercising incentive stock options with wide open possibility of a liquidity event or nothing, right? The going to zero is the more likely outcome here. A lot of our clients often are faced with decisions of, hey, should I take money out of the market, or should I borrow money? Should I take a significant portion of my net worth and put it in this private company that likely will never go public or will never be acquired? So that's the conundrum we're working with today.
Yeah. So I got a series of questions here. I'm glad you've got context. You've actually been a holder of incentive stock options. You've not only been an exceptional advisor in the space, but you also have held them in the past as well. So it really helps with wrapping our head around it. So AJ, I got a question for you here. Why are ISOs considered, amongst all the other different types of equity compensation out there, why are they considered the special snowflakes? And what makes their tax treatment so unique compared to other equity types?
Well, I would say the main difference is what happens when you exercise. There's a bunch of special rules to it, which I'm sure we'll get into. But to me, the main difference between ISOs versus non-quals and RSUs is that when you exercise, when you purchase, when you buy, those three words are interchangeable: exercise, buy, purchase. When you do that, there's no regular taxation that happens to you. That's because this is a lovely carve out. Congress gave us this carve out. They're saying, hey, you're an early employee. You're going to take a ton of risk. You're going to take some of your cash and you're going to basically invest back into this company that has no public market for these shares to be sold on. So at that moment, you are not taxed at regular income tax rates. So a lot of people make the mistake and go, oh, I'm not taxed at all. This is awesome. I'm going to exercise these options, just going to pay a little cash. Nothing shows up on my tax bill. That's all good. You and I both know, as experts in this space, that unfortunately sometimes we trigger something called alternative minimum tax, which I'm going to struggle to explain on a podcast. But there's no regular taxation, right? That's a nice benefit, which means that if you play your cards right and you exercise at the right time, hopefully your exercise price is close to the fair market value, aka what that single share of stock is worth at that moment. If those prices are close and or equal, which would be great, you probably won't owe any tax at all. So that's this really nice, unique benefit that we see with incentive stock options. Then if we hold them for a whole year, 366 days, let's not take any chances, folks. If we hold them for a whole year and we sell them in the future, we get to recognize those gains at our lower capital gains rates as opposed to ordinary income levels. So that's the main difference. Did I miss anything? Oh, I missed one main thing, which I just want to mention because it trips people up. We have this thing called the $100,000 rule, which basically your company cannot issue you in one calendar year more than $100,000, not shares, dollars worth of incentive stock options, because it's not fair, because these are so valuable. The IRS says, hey, you can't have more than $100,000 worth of these things. So if your company grants you, Shane, $1 million of ISOs that vest in 2026, unfortunately, you're going to get $100,000 worth of ISOs, and then the rest of that $900,000, those are automatically going to become non-quals, aka our regular old income tax treatment options.
Right on. So if there were 1 million shares issued at a $1 strike price, that's how we determine the value, correct? So like 100,
exactly.
like 10% of those would be. Okay, cool. So it's never a dollar strike price, so it's a little bit more difficult to do the mental math.
It's super confusing. Yeah. I mean, another thing to just think about, you asked me about like the tax treatment, but I just think we've seen hundreds of clients with ISOs. Like this is really like our expertise. We can do non-quals, we can do RSUs very well, but ISOs, the hardest one, the most complicated one, like that's our bread and butter. That's where we've been to war with clients. Another thing we see is these extremely low strike prices, because incentive stock options are often the first or second type of equity that's granted. So you might have 100,000 shares worth of ISOs, but your strike price could be 3 cents, 27 cents. So often when you're an early employee, one great strategy is to exercise, if you can afford it, those options as early as possible. And I want to come back. I want to put a pin in that word early and come back to it later too.
All right. All right, we'll circle back to the early later. But yeah, I think one other key thing just to think about when we're thinking about alternative minimum tax is that it's essentially you want to help explain like the AMT a little bit more, like dive into this parallel tax system. I think you have a funny way of explaining it to the average Netflix watcher.
Yeah, so AMT is impossible to understand in a 15-minute podcast, which is how much time we have left. It's impossible to understand in a presentation given to employees at companies, which we do a lot of at Brooklyn FI. It's impossible to explain to our new hires at Brooklyn FI who don't have equity compensation experience. So I like this analogy of, you've seen the show Stranger Things?
I have, big fan. I haven't seen the last season, but yes.
So in Stranger Things, we kind of have like the regular world, and then we have that sort of like creepy underground, like netherworld, the upside down. So I like to think of AMT as the upside down. So if you are getting in, now I've lost all the plot points of this show, but basically when Millie Bobby Brown or the little kid is like getting in the headspace of like the monster and they're going into that like creepy shadow world, they've tripped up the creepy shadow world. That's kind of what AMT is. Basically, if you do one of these activities, such as exercise instead of stock options, you trip up AMT. Which basically means, like I said, we don't pay ordinary income tax when we exercise stock options, but we might trip up AMT because our alternative minimum taxable income might be so high that when we run our income through a tax return, your accountant will say, hey, actually your income was high enough because we had to add it back in. Now you might owe some alternative minimum tax, or as we call it, AMT. Does that make any sense at all?
Yeah, for sure. And I think, something that a lot of people forget is that AMT is a flat 28% tax on your income, which means that if you're on your alternative income, without diving into that too much, but if you're not making more, like if you're not above the 28% tax bracket in regular tax land, you'll just never get exposed to it. And so it's really hard to get, not really hard to get above the 28% tax bracket, but it takes a few $100,000 it depends on if you're married or if you're single, and like a lot of things, but your average American is not, I think 90% of Americans aren't making that much money wherein it triggers it. So it just really matters if you're in like the 32, 35, 37% tax bracket in regular tax land, that's where you start to get exposed to AMT as well because of the difference between the two tax rates. So
marriage planning with equity compensation is super interesting, right? Because we could be making a new potential client could come to us and say like, hey, I know I'm getting married to my spouse. Our wedding's January 5th. Should we go to City Hall on December 30th and be married for this tax year because I'm going to exercise some incentive stock options? There's some interesting planning there we can do with AMT when we have two incomes. And that's, you and I do tons of tax projections, or used to, and everything's moot once we have a spouse because all that income's going on one tax return. So all that careful planning we did goes right out the door.
Yeah. One of my favorite stories about this is a guy came to me, a Wall Street banker, and his wife was making just as much as him. They were both making a ton of money. And he was like, I'm going to get married in December, but what would happen if I got married in January? Like, what if we push it back? This is like in June. And I ran the numbers, and it was going to save him like $45,000 because of the marriage penalty if he pushed it back to January. I saw him next tax season in March, and I was like, so did you guys get married in January? He's like, no, we're fairing MFJ this year. Yeah. Spouse didn't care about saving $45K. Yeah, we're not changing the invitations.
Everybody's right. Yeah, everyone's right. Oh, the invitations had already gone out? All right.
Yeah. So I was like 26 at the time. I was like, all right, whatever, moving on. I don't know anything about that. Yeah. Yeah, so that's fun. So I think one other thing that we just might want to discuss about the AMT is that it's really just like a bit of context and history. There's so many tax loopholes and so many tax breaks within the regular tax land to help incentivize things that an alternative tax land, it's designed to remove all tax breaks and most tax credits and anything that allows people to game the tax system. So if you've got all these depreciation deductions, or you have these incentive stock options, or if you've got these oil and drilling write-offs and all this wacky stuff that's been inserted into the tax law over the past 70 years of corruption, then they'll all get reversed and get added back into your income. So in some ways it sounds super complicated, but in other ways it's just really like, what was your total amount of income that flowed into your life without any deductions, credits, subtractions, et cetera? just to oversimplify it. So
that's a great way to put it. Yeah, it's just any deductions that you thought you were getting, let's take them away because you got too many deductions. So let's put them back in. Is a good way to put it.
Yeah, and then we get a flat tax rate on that. And hey, look, let's keep things simple, which is a great way to kind of make sure everyone pays their fair share. So moving on from that, I would love to see when do you think you should exercise your incentive stock options, AJ, given that this is one of the cool types of equity compensation, with RSUs and restricted stock, when they vest, they're automatically included in your income, and unless they're double trigger, they're automatically included in your income. So you can't really control, you don't even get to pick like the fair market value of the item that's vesting. That's at, the market's discretion or 409A valuations. But with incentive stock options, you get to decide when the tax happens to you. So do you have any tips for deciding when the tax is going to hit you?
Yeah. I mean, this is such a personal decision, but let's set some ground rules. In my opinion, the earlier the better, as long as the total cash outlay that you have to lay out, plus any taxes that you might trip up, we just talked about that AMT, as long as it's less than 5% of your investable net worth, I say exercise your ISOs as early and often as possible. That's it. That said, if you're like, my company is dog shit and it's not going anywhere, I don't believe in this company, okay, you might not want to exercise your ISOs. But this shouldn't be an emotional decision, right? Just because you don't like your boss doesn't mean your company isn't going to be successful and go public at some point. So take the emotion out of it. But if there's a reasonable possibility that your company either goes public or is acquired or merges into another company at some point, exercising your options as early as possible is a good idea. And I mentioned this earlier, I'm going to say it again in the hope that it sticks. The best time to exercise your incentive stock options is when the current fair market value of a share of your company is equal to your strike price, which means AMT doesn't matter. We're not going to pay it because you're actually not getting any discount or bargain. There's no bargain element. There's no difference between your price and the price that any new employee would pay to exercise options. So that's the ideal moment to exercise options. So if you have that scenario and your strike price is sub $1 and you've got 10,000 shares and you've got $1 million in the bank, I love incentive stock options. You and I have seen deca millionaires created over short periods of time because of really smart incentive stock option planning. There's a lot we can do to pay taxes or pay very minimal taxes now and only pay long-term capital gains in the future. I have to mention it because we're talking about advanced equity compensation stuff, but I have to mention QSBS, Qualified Small Business Stock. To kind of hype up a future episode, we've got a QSBS expert, one of the best QSB expert minds in the country, coming on this podcast in a few weeks. So if you're into that and you want to go into a deep dive into the America's best tax loophole, in my opinion, this is the ability to exclude $10 million of gain when you sell your stock if you were an early investor. So to me, the perfect story of ISOs is you get your shares granted, you exercise as soon as they vest when your strike price is equal to the fair market value. At that time, your company is qualified small business. It's got less than 50 million in assets and hits all the other qualifications. You wait 5 years, you sell that after 5 years, you make $11 million and 10 of that is completely tax-free because you qualified for the small Section 1202, folks, look it up.
Yet another tax law designed to help the middle class, old Section 12.
Yes, exactly. Yes.
I know my Jiffy Lube mechanic abused Section 1202 when he...
That's so weird. I was just going to also say auto mechanic. I don't know why we always go to that analogy.
I think it's just like the most blue collar thing that you interact with as an average American, but, not just like when you have another question for you, AJ, when it comes to timing the incentive stock option exercises, but not just like when you've got the cash or like strategically, but talk to me about also like within a calendar year, like talk to me like when that might make the most sense given the tax laws that we're looking at.
April 1st is the best day to exercise your options because you get this amazing tax benefit just because April 1st is the April Fool's Day. So you actually get a $20 million lifetime exclusion for, I'm just kidding. That
was the first for me. Didn't know where you were going with that.
No. There's no special. I mean, I think generally earlier in the year, the earlier we can exercise, the better, because it gives us more optionality. If we exercise our stock options in January, we have 11 months to decide if we want to disqualify them. If we are exercising shares at a public company, what we could do is we could exercise them instead of paying the AMT and waiting a whole year to hold them. We could actually just go ahead and sell them and just take the tax hit with ordinary income because our tax professional has done a tax projection and told us that that's a better move. So it just gives us more optionality. The problem with exercising so late in the year is you're going to have to pay your AMT bill on April 15th. So if we're exercising, it's the end of the year and you're like, oh crap, I forgot to exercise my options. We're going to exercise on November 30th. You only have a few months to pay any potential AMT, and you don't have any rest of the year to decide if you want to change your mind or not. Once you hit that exercise, there's no going back. Any thoughts on that I missed with timing?
Well, yeah, I mean, it's nice to know, like, don't let missed opportunities in the past. So you don't cry over that. But yeah, I think January is the best time. You get 11 months to decide if you want to disqualify your options and make them ordinary. I mean, obviously we all wish that we had exercised them or early exercise them after our company does well, but we don't really hear many stories from people about exercising options that are worthless, right? I mean, my dad talked about it all the time with his damn options when he worked at casinos during the Great Recession. But yeah, what do you think?
I was just going to say, I feel like we think a lot in like absolutes. It's like, oh, it's going to cost me $100,000 to exercise all my options. It's like, well, you don't have to exercise all of them. We can create some optionality. Why don't you come up with a budget with your partner and your financial planner and your CPA and say, look, we have $10,000 to risk on this. If $10,000 went away tomorrow, it wouldn't materially impact our ability to pay for our lives and retire in the future. So let's just take $10,000. That's maybe that's only 15% of your options. But I love that idea of just doing a little bit. Also, doing anything like this is always like a paperwork headache. And it's always like knowing who's the right person at your company to ask. So even just like going through the motions of exercising your options once early on when it's like low stakes and there's no whisperings of an IPO, it's just a good idea. That way we have diversity in bargain element, meaning if we exercise in different years, we're going to have different tranches of shares that we can sell for different amounts of gain in the future. And, when a client comes to me and says, oh, I've been exercising my incentive stock options once a year for the past 4 years, I like salivate. I'm like, oh my God, I'm so excited to do a tax plan because we can actually optimize your gains over the next couple of years based on your income. And if you're going to quit your job this year, oh my God, I can save you tens of thousands of dollars in taxes because we have all these different levers we can pull and we can choose which lots to sell.
Perfect. I love it. Diversification in an interesting way. So we've got just a few minutes left, AJ. I've got 2 more questions for you. One of them is incredibly difficult to pull off. So I am going to pass you a difficult baton to carry here. How does the minimum tax credit work? What is it? How do we use it? How do we take advantage of it? How do we make sure we don't lose it? Talk to us.
I had an analogy for this, but I'm not sure that it works. I don't like it. I don't think it's good enough. It's not far enough away. But essentially, we talked about the alternative minimum tax. So let's just keep our numbers pretty simple. I can't do arithmetic in my head, so that's a good reason to keep our numbers simple. But let's say last year in 2024, Shane, you exercised a bunch of stock options and you generated $100,000 in alternative minimum tax. Now that is tax that you have to pay. That will be due in a couple of months or just a couple of weeks, really. On April 15th, you will have to write a check to the IRS for $100,000 for that exercise. Sucks, right? However, hopefully your accountant filed your tax return correctly. And that $100,000, you have the opportunity to get back in the future when you sell those shares. So fast forward to now it's 2025, new tax year, right? You played your cards right. Your company went public. Amazing. That's great. You're going to sell not all those shares. You're going to sell 50% of those shares for a nice little gain. So in 2025, you're going to have income that's going to be higher. Oh God, now you caught me here. Your income is going to be higher in regular tax land than your income in alternative minimum tax land. So there's going to be a delta. You're not going to owe AMT this year. And you have that $100,000 deposit that you made into the bank of the IRS that you can earn back. So to keep things super simple, let's say your income this year is $1 million in regular tax land, and in alternative minimum tax land, it's $900,000. So there's $100,000 delta between your regular tax, which is higher, your regular taxable income, and your alternative minimum taxable income. So we get to take that whole credit back as literally a tax credit. So you paid it in 2024, but because you had much higher income and you didn't do any nonsense in AMT land like exercise options or have oil and gas partnerships, you got that whole credit back. Now that's a lovely story. What happens in reality is that most people don't exit fully in the next year. So that $100,000 lives as a tax credit on their tax return. Now, Shane, what have we seen mistakes happen, and how can people accidentally lose that credit that they are due? It just might, the credit, you might not get it back in 1 year. It might take many years to actually recoup that full $100,000. So what have we seen happen?
So arithmetic aside, what I'm hearing is this alternative minimum tax was designed to make sure that these high income people pay their fair share, but in reality, whatever they pay, they get back in the future. So it's just like a loan to the government.
Yeah. Yes, okay. That's a great way to put it. Yeah.
Got it. Cool. All right. Okay. Anyway, so that's silly, but love the complexities of the U.S. tax system.
I forgot I was going to be tax bimbo today. Oh, man. Oh, well, she'll be back.
Next time. She'll be back. Oh, I know. You should, there should be a special tax bimbo episode just ahead of the tax deadline. So to answer your question, which I think will be the last answer we have time for today, we have seen people, unfortunately, they don't know much about the incentive stock option issue. They go hire their CPA. Maybe it's their first time hiring a CPA because they've heard about this issue. That CPA gives them the unfortunate news that they owe a ton of money because of the actions that happened last year. It's not the CPA's fault, but because they worked with a CPA that said, hey, you guys owe $40,000 when they're used to getting refunds there. And in a very natural response, they say, I don't like the CPA.
Bye, you're fired.
So they fire them, and then they decide to go back to what they're used to, maybe a TurboTax, maybe a less professional tax preparer. And that specialized tax credit that needs to be very carefully tracked on the tax returns is not carried forward into the future. So they just lose it. And, you have to file your tax return correctly in order to take advantage of this recuperation of the minimum tax credit that you paid in the past. So I remember a young family came to us one day and they were struggling to buy a used car and they were struggling to figure out how to pay for cribs and stuff like that. We looked at the tax returns and they had $50,000 of tax credits that they had lost that we were able to amend returns and put back into their pocket. Not to virtue signal or anything, but listen, you need to work with professionals in this space in order to make sure that you don't lose, when you're working with super complicated issues within the U.S. tax system. Unfortunately,
and that's happened. Four times I can think of. I'm sure it's happened more than that because I don't work with every single client, but it's right. Not like a 1 in a million. Like it happens often, folks.
Yeah, the IRS doesn't send you a letter to remind you about tax credits that you missed, unfortunately. Yeah. And on that funny note, I think that's all of the time that we have for today. Tax Bimbo, anything else you want to add?
I have so many more horror stories and success stories of ISOs. We'll have to do a follow-up episode of anecdotes only. Only anecdotes.
Only anecdotes. Only plans, back at it. Only goofed plans in our next episode. Thank you so much for listening, dear listener. Email us your financial problems at liquidityevent@brooklynify.com. Leave us a voicemail at memo.fm/the-liquidity-event and we'll play it on the air. And finally, all you stans out there can leave us a 5-star review if you want to be weird about it. Stalker, thanks so much.
See you next week. Bye.